Something occurred on December 26, 2025, that should alarm every investor watching this right now. While most people were still enjoying the calm after Christmas, the Federal Reserve Bank of New York quietly injected $17 billion in emergency cash into the U.S. banking system. $17 billion deployed in a single morning at 8:08 a.m. This was not a scheduled operation. It was not routine liquidity management. This was a financial fire alarm going off while the country slept through a holiday hangover. Here's why this matters. According to an exclusive report published on December 29th by investigative journalist David K. Johnston, this emergency injection is directly tied to a catastrophic position in the silver market. A position so massive and so deeply underwater that it forced the Federal Reserve to intervene with billions in backdoor support. The bank involved, JP Chase. The exposure, $13.7 billion. The metal at the center of the chaos, silver. Let me break down exactly what's happening, why JP Morgan is trapped, and why the U.S. government has just realized it has lost control over one of the most critical industrial metals on the planet. According to the Federal Reserve's own public data, repo operations, essentially emergency overnight loans to banks secured by collateral, had been sitting near zero for years. Through most of 2024 and into 2025, these facilities were dormant. Banks didn't need them. The system appeared stable. Then something changed. In late October 2025, repo usage began rising. By Halloween, tens of billions of dollars were being borrowed. By December, outstanding repo balances exceeded $40 billion. And then, on December 26th, the day after Christmas, a single institution borrowed $17 billion in one transaction. Think about that timing. Christmas Day is a federal holiday. Markets are closed. And yet, someone needed $17 billion so urgently that the Fed opened its emergency window at 8 in the morning the very next day. David K. Johnston connected the dots. This was not broad market stress. This was silver, specifically a bank that made a catastrophic bet on silver prices and is now facing an existential threat. For years, JP Chase was the most aggressive short seller in the silver market. They held a massive 200 million ounce short position, betting silver prices would fall. Their activity was so extreme that in 2020, they paid over $920 million in fines for manipulating precious metals markets. That's not speculation. That's documented federal court record. But in 2024 and 2025, everything changed. Silver didn't fall, it exploded. From January 2025 to December 2025, silver prices surged 144%. A metal trading near $23 per ounce in early 2024 blasted through $50, then $60, then touched $86, before settling into the $70 to $80 range, where it trades today in January 2026. JP Morgan didn't just get caught short, they panicked and flipped. According to the latest COMEX delivery data from January 2026, JP Morgan went from a 200 million ounce short position to holding 750 million ounces long. They went from betting against silver to desperately trying to secure physical metal. From the largest short to the largest long position ever recorded. Here's the problem. There isn't a T enough tradable silver on Earth to exit a position that large. Johnston's DCR report calculates JP Morgan's exposure at $13.7 billion, roughly equal to the bank's profits over a 90-day period. One bad quarter, one wrong move, and a bank that survived 2008 could face a liquidity crisis over a metal most people still think is just used for jewelry. Now it gets worse. On January 1st, 2026, just 6 days ago, China activated new export licensing restrictions on silver. These rules, announced by the Ministry of Commerce in late 2025, limit refined silver exports to just 44 authorized companies, controlling about 121 million ounces annually, roughly 60 to 70% of global refined silver trade. China didn't ban exports. They did something smarter. They created a choke point. Here's the insane part. In the first 11 months of 2025, China exported over 4,000 tons of silver while importing only 220 tons. They are a net exporter. They have the supply, but now they control who gets it, when they get it, and at what price. The Shanghai silver premium, what buyers in China are paying above COMEX prices, is now running 8 to 10 per ounce. That's not a minor arbitrage. That's a massive pricing dislocation, pulling physical silver out of Western vaults and into Chinese warehouses. Even Elon Musk weighed in. On December 27th, he posted on X criticizing the restrictions and highlighting silver's essential role in industrial processes. When the richest man in the world is publicly worried about silver supply chains, something fundamental is broken. Now connect the dots. JP Morgan holds 750 million ounces of long exposure in a world where total annual mine production is only 835 million ounces. They need physical metal to exit. China just locked down most of the refined supply. And the Fed injected $17 billion on December 26th to an unnamed bank facing collateral stress. JP Morgan is trapped. They can't exit without driving prices even higher. They can't secure delivery because China controls supply. They can't hold indefinitely because the carrying costs on that position are bleeding them. The Fed knows it, JP Morgan knows it, and now China knows it. This isn't a normal market correction. This is a systemically important bank stuck in a position it cannot mathematically escape, inside a metal the U.S. desperately needs but no longer controls. And that $17 billion Christmas bailout? That was just the opening move. The warning signs were already there. On December 10th, 2025, 16 days before the emergency injection, the Federal Reserve quietly removed the aggregate operational limit on its standing repo facility. No cap, no ceiling, unlimited liquidity. That's not routine policy. That's what central banks do when they're preparing for something to break. The last time the Fed offered unlimited repo operations was March 2020 during the COVID crash. Before that, September 2019. Unlimited repo is the financial equivalent of fire trucks lining up outside a building before the flames are visible. Now line up the timeline. Silver hit its 2025 high of 86.41 on December 18th, 8 days after the Fed AS policy change. It then corrected into the mid-70s by Christmas. That correction is when margin calls hit. That's when someone needed $17 billion just to survive. This crisis isn't about paper speculation, it's about physical metal. In October 2025, silver entered backwardation, a rare condition where near-term contracts trade above longer-dated ones. That only happens when immediate physical supply is tight. The market values metal in hand more than future promises. COMEX inventories confirm it. Registered silver, the metal actually available for delivery, has fallen below 80 million ounces, levels not seen since 2015, backing billions of ounces of paper claims. That leverage ratio would terrify any risk manager. On November 7th, 2025, the U.S. Geological Survey officially added silver to its critical minerals list for the first time. That classification unlocks federal authorities, defense funding, and emergency powers. Yet despite allocating $7 billion for critical minerals, the U.S. government allocated $0 specifically for silver stockpiling. Zero. The U.S. uses about 35 million ounces of silver annually just for defense systems, missiles, radar, aircraft, submarines, and the National Defense Stockpile has held no silver since 2002. China, meanwhile, has stockpiled silver and now controls exports. This is the reality. JP Morgan is trapped. The Fed is intervening. China has leverage. And the U.S. just realized it built its industrial and military future on a metal it doesn't control. This is not just a market story. It's a systemic breakdown. And we are dangerously unprepared. Second, ore grades at mature mining operations are declining. Mexico, Peru, and China, the world's top silver-producing countries, are all experiencing grade degradation. That means miners now have to process significantly more, or just to extract the same amount of silver as before. Third, permitting timelines for new mines in most developed countries now stretch 10 to 15 years. Even if companies decided today to bring new primary silver production online, meaningful new supply wouldn't reach the market until 2035 at the earliest. So the 820 million ounce deficit that has already been drawn down from inventories is not coming back. That metal is gone. It's embedded in solar panels installed across China. It's locked into circuit boards, sitting in warehouses waiting for assembly. It's stored in ETF vaults where investors are holding physical silver. And now JP Morgan needs 750 million ounces of it. Do you see the problem? Now let me give you a specific date that could ignite the next phase of this crisis. January 9th, 2026, this Thursday. On that day, the Bloomberg Commodity Index, one of the largest benchmarks followed by institutional investors, conducts its annual rebalancing. Silver LOES weighting in the index is being reduced from roughly 6% to just under 4%. That sounds technical and boring, but here's what it actually means. Funds tracking the index are forced to sell approximately $5 billion worth of silver futures over a 5-day period starting January 9th. $5 billion of selling pressure in a single week. DD Securities, one of the major banks that tracks commodity flows, published a note on January 3rd stating, "We expect a massive 13% of aggregate open interest in COMEX silver markets will be sold over the coming 2 weeks, resulting in a dramatic repricing lower." They're predicting a price crash, and in the short term, they may be right. But here's what makes this moment absolutely critical. If silver prices crash, JP Morgan's collateral value crashes with it. Remember, they're holding 750 million ounces of long exposure. A $10 drop in silver prices translates into $7.5 billion in mark-to-market losses. That's why the Fed handed them $17 billion on December 26th. They knew this rebalancing was coming. They knew JP Morgan would need a liquidity cushion just to survive the volatility. But what happens if that selling triggers a cascade? What happens if other banks with silver exposure face margin calls at the same time? What happens if paper market selling widens the gap with the physical market, where supply is genuinely scarce? You get a scenario where silver crashes on paper while physical premiums explode higher. You get a market that literally breaks, and that's when things become truly dangerous. Now let's look at where the smart money is positioning for 2026. Citigroup, in its December 2025 commodities outlook, stated that silver will continue to outperform gold and projected prices in the high 70s for 2026. Bank of America raised its 12-month silver target to $65, calling it conservative given supply constraints. UBS forecasts silver averaging $50 in 2026, with potential runs towards $60 later in the year. Those are the conservative calls. The more bullish analysts, those looking at the same structural deficit data we just walked through, are projecting far higher prices. Frank Holmes of U.S. Global Investors told Investors News Network, "I think silver will be over $100. Felipe Geles, Chief Strategy Officer at BNP Paribas, told CNBC he would not be surprised to see silver well north of $100 in the not-too-distant future. And veteran technical analyst Michael Oliver, who correctly predicted silver's 2020 rally, has outlined scenarios ranging from $100 to $200 silver by early to mid-2026. Why such a wide range of forecasts? Because no one knows what happens when a systemically important bank is trapped in a position this large during a real physical supply crisis. In a normal market, price targets can be modeled using supply and demand fundamentals. But this isn't a normal market. This is a market where one institution holds more long exposure than total annual U.S. silver production, where China controls 70% of refined supply and has just weaponized that control, where the Federal Reserve is already injecting emergency liquidity. At this point, price targets aren't about fundamentals anymore. They're about how high silver has to go before something breaks. There are three possible ways this resolves, and two of them are catastrophic. Scenario 1, the controlled crash. Bloomberg rebalancing, selling pushes silver down into the $50-$60 range. JP Morgan absorbs massive mark-to-market losses, but survives with continued Fed support. Physical premiums spike as the paper-physical disconnect widens. China buys the dip. Western investors panic sell. Silver slowly bleeds lower through Q1 of 2026. Probability, 30%. Why? Because this requires China to release supply, the Fed to maintain unlimited support, and no other major banks to be exposed. Too many things have to go right. Scenario 2, the short squeeze. The rebalancing triggers the expected crash. Silver drops to $60, but physical delivery demands overwhelmed COMEX inventories. Someone, JP Morgan or another institution, fails to deliver. COMEX either changes the rules like it did during the Hunt Brothers episode, or prices explode as longs demand metal. Silver surges to $100, $150 within weeks. Probability, 40%. Why? Because the physical shortage is real, China's restrictions are binding, and JP Morgan is unlikely to be the only institution positioned incorrectly. Scenario 3, government intervention. The Fed, Treasury, and CFTC hold emergency meetings before January 9th. A forced settlement is imposed. JP Morgan is allowed to cash settle at a predetermined price. COMEX retroactively alters position limits. China is offered trade concessions to release supply. Probability, 30%. Why? Governments hate visible market failures. They'll try to manage this quietly, but China has little incentive to cooperate. Here's what you need to watch over the next 2 weeks. If silver drops below $60 during rebalancing, while Shanghai premiums spike above $15, that's confirmation physical shortages are overwhelming paper selling. If the Fed conducts another repo operation above $10 billion between January 9th and 16th, another institution is in trouble. If China changes its export licensing, tightening or loosening, that's Beijing signaling its next move. And if COMEX adjusts margin requirements or delivery rules again, that means they're preparing for default. Let's bring this back to where we started. On December 26, 2025, the Federal Reserve injected $17 billion into the banking system to keep a major institution solvent during a silver market crisis. All available evidence points to JP Morgan Chase, holding a 750 million ounce long position it cannot exit. China controls 70% of refined silver supply and just locked it behind export licenses. The United States classified silver as a critical mineral, but allocated $0 for stockpiling. And starting January 9th, $5 billion in forced selling could trigger the volatility that collapses this entire structure. This isn't speculation, it's math. JP Morgan cannot close its position without driving prices higher. It cannot secure physical delivery without China's cooperation, and it cannot hold indefinitely without the Fed. The Fed bought them a few weeks with that $17 billion, but every day this position remains open. The systemic risk grows. silver is no longer just a precious metal, it's a threat to financial stability. And whether this breaks publicly or gets managed behind closed doors, one thing is certain, it's breaking. Watch January 9th.